On the 1st of July, 2026, a single news story wiped billions off two companies before lunch. Meta didn't launch a phone. It didn't launch a headset. It said it would start selling something it already owned: electricity, silicon, and floor space. By the closing bell, Meta had added roughly $125 billion in market value. CoreWeave fell 14%. Nebius fell 17%. That's not even the strangest part of the story. The strangest part is who Meta wants as a customer. Inside the company, it already has a name: Meta Compute. Santosh Janardhan runs it, alongside Daniel Gross out of Superintelligence Labs and company president Dina Powell McCormick. The plan splits clean down the middle. One half rents raw graphics processing power by the hour, exactly the way CoreWeave does it. The other half sells access to Meta's own models, Muse Spark included, running on Meta's own hardware, the way Amazon resells other people's intelligence. No pricing, no launch date, no named customers. The market moved anyway. And none of it was improvised. Back in October, Zuckerberg mentioned that companies kept asking whether Meta had compute they could buy at some premium to what Meta had paid for it. In May, he said a cloud business was definitely on the table. A former senior Amazon Web Services executive is on his way into the building. The plumbing had been going in for a year before anybody read the headline. Sit with why that reaction was so violent. For 3 years, the entire investment case for a company like CoreWeave rested on one assumption: that the giants would rather rent than build and sell. Meta was the living proof. It signed roughly $21 billion with CoreWeave and up to $27 billion with Nebius. Then their biggest customer stood up and suggested it might become their biggest competitor. Bernstein called it problematic, which in analyst language is very close to a scream. There's a detail underneath that worth holding on to. CoreWeave borrowed against contracted cash flow, including Meta's. In March, it priced the first investment-grade, chip-backed financing Wall Street had ever seen. If the contracts underneath thin out, so does the collateral. That wasn't a stock reacting to competition. That was a stock discovering its foundation was rented. To understand how Meta ended up here, go back to March. Meta went to Google and asked to buy more Gemini capacity. Google said no, not out of spite, out of shortage. Google's backlog of signed but undelivered cloud contracts had passed $460 billion, and Sundar Pichai admitted out loud that his own revenue would have been higher if he'd simply had machines to sell. So a company worth more than $1 trillion got rationed. Projects slipped. Employees were told to spend their AI tokens more carefully. Imagine that memo landing in your inbox. That is the exact moment the strategy changed. Meta had been buying intelligence from a company it competes with, and the tap tightened. In April, it launched Muse Spark, the first model out of Meta Superintelligence Labs, the unit built around Alexander Wang after Meta paid $14.3 billion for a 49% stake in Scale AI. In May, it cut 8,000 jobs and moved 7,000 people into AI roles. In July, it shipped Muse Spark 1.1 and started training something bigger, codenamed Watermelon. Every step points the same direction. Own the stack. Depend on nobody. Owning the stack costs more than most countries earn. $39 billion in capital expenditure in 2024, $72 billion in 2025. This year, the guidance runs from $125 to $145 billion. As of the end of March, Meta's own filings showed $182.9 billion committed to AI infrastructure. In Ohio, there's a campus Zuckerberg has described as the size of Manhattan due to come online this year. In July, Meta and BlackRock announced a venture to finance another one in El Paso. That isn't a budget. That's a national infrastructure program run by an advertising company, and unlike Google or Microsoft, Meta had nothing at the end of it to sell. Every dollar went into machines that served ads and answered questions inside Meta's own apps. Meta doesn't break out revenue from Meta AI. Executives talk about internal uses. That's $180 billion of infrastructure with no external price tag attached to it, and that hole is exactly what Meta Compute was designed to fill. Drive out to Richland Parish, Louisiana, and you can stand where some of that money lands. The site is called Hyperion. Nearly 10 million square feet, 5 gigawatts, $50 billion and climbing. Local businesses have taken more than $1.5 billion in contracts. Teacher bonuses in the parish went from $10,000 to more than $50,000. In a rural place that hasn't seen much of that kind of money, it is real and it matters. But there is a second ledger, and it's written in smaller print. A consultant for the state regulator found the gas plants feeding Hyperion could add $8 to $13 a month to residential bills. The registered water draw is 23 million gallons a day, close to doubling withdrawals for the entire parish. The financing runs through a $27 billion private bond described as the largest corporate bond issue in history, structured so most of the debt never touches Meta's public balance sheet. And Meta's lease lets it walk away as early as 2033. Logan Burke, who runs the Alliance for Affordable Energy, put it plainly, Meta can leave, and Louisiana families keep paying for the wires and the gas plants for decades afterward. This July, a judge ordered Meta to hand over evidence it had tried to keep sealed. Both things are true at the same time. Quick pause. If this is useful, hit like and subscribe. It genuinely helps this channel grow. Now, back to the part nobody saw coming. Because in the middle of July, reporting emerged that Anthropic, the maker of Claude, a direct competitor to everything Meta Superintelligence Labs is building, was in early talks to lease around $10 billion of Meta's compute over 2 years. Anthropic asked first back in June, and Meta wasn't even the first mover here. Weeks earlier, Elon Musk's SpaceX had started renting out its own capacity, selling the entire output of one data center to Anthropic in May. Look at the shape of that. Google rations Meta. Meta rents to Anthropic. SpaceX sells to Google and Anthropic both. The competitive lines have dissolved because nobody on Earth has enough machines. There are two honest ways to read all of this. Read it one way, and Meta just found itself a second business. Amazon Web Services made $115 billion last year, and even a fraction of that turns Meta's spending from a cost investors tolerate into an asset they'll happily pay for. Read it the other way, and a company only sells surplus if it has surplus. Meta spent 2 years insisting demand for its own compute was insatiable. Selling it is an admission that it isn't. There's a version of the bull case that has nothing to do with cloud revenue at all. Meta's advertising engine is still extraordinary. 33% revenue growth last quarter, a 41% operating margin, 19% more ads shown, and 12% more charged for each one. That's what AI spending looks like when it works. Then there's Reality Labs, which lost $4 billion in a single quarter on $402 million in revenue. A reminder that this company has bet enormous sums on a future before, and the future arrived late. The numbers land tonight. Wall Street wants $60.2 billion in revenue and about $7.18 a share. Revenue is expected to grow 27%, while earnings per share grow about 1. That gap is the entire story. And there's a mechanical problem sitting underneath it. Meta spent under $20 billion on capital expenditure in the first quarter, well below what analysts had penciled in. Run its own guidance forward, and the remaining quarters have to carry $35 to $40 billion each. Whatever Meta underpaid in the spring, it owes tonight. The chips are booked immediately and depreciate over 4 to 6 years. The payoff is still a promise. The stock already sits roughly 25% below its high, and the market has stopped rewarding ambition and started asking for receipts. Here's why this matters, even if you never own a single share. The last great platform shift was decided by who wrote the best software. This one is being decided by who can pour concrete, string transmission lines, and get turbines connected to a grid. Intelligence has become an industrial commodity priced by the gigawatt, and the companies that win may simply be the ones who own the buildings. Zuckerberg has said he'd rather front-load capacity and be wrong about the timing than be right about it and have nothing to run. So Meta didn't blow up the tech market with a product. It blew it up with a landlord's business plan. A company that spent 20 years selling your attention now wants to sell the machines that think. And somewhere in Richland Parish tonight, a family is opening an electricity bill that will help decide whether he was right. If you liked this video, don't forget to subscribe to the channel. There's a lot more coming.